Good morning, everyone. Welcome to another edition of PE Forum. Today, we have the pleasure of welcoming Frans VanSchaik. Frans is the founding chairman and CEO of African Asset Finance Company, Inc., AAFC, the chair of AAFC subsidiary Ease Holding, and the founding CEO of Cathmere LLC, a securitization fintech company incubated by AAFC. AAFC and Cathmere are Roha Portfolio companies where Frans is a partner since 2014. He also serves on the board member of several Roha Group companies and Roha Portfolio companies, including Raxio Group and Arat Health. Frans, thank you so much for taking the time and joining us today. As we mentioned, AAFC is focused on Africa, and we'd love to, focus with you a bit as we start on the opportunities that are presented in Africa. And if we look at the current, geopolitical, macroeconomical outlook of Africa, what would you say that stakeholders should be aware of? What are the changes? What is happening in the economic outlook of the African continent?
Well, Khaled, thank you first of all for having me. It's a great pleasure to see you as always. That question is impossible to answer, to be honest. Africa is huge. So I think the first problem is that most people, especially back here in the US, think of Africa as a country. It's actually it's 55 countries or 54 or 56, depending a little bit on where you stand in the local political spectrum. But so there is no such thing as one Africa. There is a huge difference between the Northern Africa countries and Sub-Saharan Africa countries, and then even then, these are widely different. So I think just for you, you can't compare the economy or the situation in Egypt to the one in Morocco, just as you can't compare DRC to Kenya or Ethiopia to South Africa, or it's just impossible. So and I think that that's one of the things that make it complicated, because you have this collection of countries of people that don't speak each other's language, that actually, unlike the bizarre thing in Africa is that if you're an African, it's more difficult for you to travel from one country to the other than it is as a European or an American, because it's much easier to get visa and get into these countries. So it's difficult to talk about Africa as a whole. So I think if you wanted to talk about Africa as a whole, then I think it's not dissimilar from talking about other emerging markets. So where is the macro situation? The macro situation in Africa is that the continent is settled with high debt, relatively speaking. As of course the US debt is much higher as a percentage of GDP than any African country, but the economy is also different. So for emerging market economies, if you have 60% debt of your GDP, that's a high debt burden. So I think that's one of the issues. The other issue is that with a high interest rate, all of these countries are getting into trouble because they don't generate enough foreign currency to actually pay their debt. So I think by and large, almost every African country is strapped for cash. That's one thing, and that leads to currency shortages. That leads to high inflation locally, and it leads to very low real economic growth. And I think, to be honest, I think IMF is trying to put a positive spin on it, and they have always been trying to do that because otherwise they have difficulty justifying some of the support. But I frankly do not believe that the IMF numbers, or at least the forecasts, are correct. So I think that's the biggest issue. Is there a way out? Probably yes. I think we will see more debt restructuring. I think we will see, in some countries, we will see growth picking up again. But I think the largest part is that Africa as a whole needs to get on the value-added bandwagon. and that's where the issue is. So why is Morocco doing well? Because Morocco is actually becoming one of the larger exporters of automobiles to Europe. So it's become it's increasingly successful in adding value in its local market. Why our countries, many countries in Africa are not doing great is because if they export something, they only export the raw material. And Nigeria is a good example that exports oil. Unfortunately, a lot of it gets lost or stolen or whatever you want to call it. But they import refined petroleum products. So what they gain on one hand, they lose again on the other. Now, some of these things are changing. Dangote just opened a refinery in Nigeria. Nigeria has a lot of other problems, but so macro, it's really you have to pick your opportunities. It's
so exactly, if we have to pick our opportunities, and you mentioned Africa is, it's diverse markets. Where or which countries do you see a gap or an opportunity that can be beneficial for investors? Which markets do you see new opportunities today?
Yeah, so the problem in Africa is that the opportunities are very much linked to your expectation for that country, and part of that is a political calculation. So the continent is by and large has a lot of countries that are not terribly stable, and even if they have been stable for the last decade or 2 decades, then if you look at the underlying forces that are at work, then you have to question how sustainable that stability is. So almost every country in Africa has the question: will there be a peaceful transition of power? Will there be a transition of power first, or will there be a change of constitution that allows for whoever it is that is in power to stay in power? And if it is happening, is it peaceful enough? And that, for a lot of investors, that's a key thing. So what you see happening is that international companies invest in Africa, but typically in things that give almost immediate transactional rewards. So long-term investments where you have to wait for the return in 5 to 10 years or longer, those are tricky. And you see, for instance, you see this, Total just experienced this in Mozambique. They invested in Mozambique, a large gas facility in the north of the country. They had to stop it, I think, at least twice, and it was questionable whether they would restart because of unrest. Now, I think long term that will probably still happen and will eventually happen, but it could also not happen. Nigeria is a good example, where all the large oil companies have effectively just withdrawn over time, and nobody has really stepped in. So it's not a given that these things are cyclical. They may actually be at some point become structural. So having said that, you have to make a big difference. So the other problem is in these African countries is that the economies are small. They're tiny. There's a lot of people. But it's also a vast geographical area. And so if you look at South Africa, which has a sizable economy and a big population, Nigeria has a sizable economy and a big population, but actually is not really doing anything. It's so problematic that it's faltering. But if you look at other populous countries like Ethiopia, for instance, which I think is the second or the third largest country population-wise in Africa, and is also a large country, just like Angola is a large country, their GDP is almost nothing. I mean, it's it depends a little bit how you measure. It's 100 billion GDP, but if you value the economy at the black market rate, it's actually half of that. And that's a little bit your issue. You talk about countries where, despite the fact there are a lot of people, the discretionary income or the number of people with discretionary income is actually very low. And what that means for typical private equity investors who invest in companies that rely ultimately on people buying their products or their services, that they look at tiny markets. You look at, if you think about, I don't know the exact numbers, but in a lot of countries, for instance, Kenya, with a population of 50 or 60 million, only 10% of that population is formally employed.
Mm-hmm.
The rest is informally employed. That doesn't mean necessarily they're doing poorly, but it does mean that it's difficult to tap in that market in a meaningful way.
Mm-hmm.
But more generally, if you have a population that on average has where the GDP per capita is, $1,000 or $1,500 or $2,000 or even $2,500 per annum, that doesn't leave those people an awful lot of leeway to spend money on more than just paying for the bare essentials. So that means that, you can have a successful business if you service the bottom of the pyramid with something that is essential, but the moment it becomes a luxury, it becomes tricky.
Mm-hmm. It's very interesting. And so, if you mentioned several points, and do you feel that there's a misunderstanding from international investors on the African different markets and the opportunities there? And also you mentioned IMF and the numbers. How do you see institutional investors' approach to Africa? Do you see it as a positive one, or do you think that there should be some transformation in the way they invest or look at enhancing conditions in the various countries where they invest?
Well, the traditional institutional investors are largely absent in Africa. So if you look at the private equity landscape, it's I don't know the exact numbers, but it's vast majority funded by development finance institutions.
Mm-hmm.
So and they have created what they call private equity, which is actually more a growth equity venture type environment, which has been by all metrics terribly disappointing, very, very unsuccessful. Mm-hmm. There's some exceptions, but by and large, most private equity, venture capital, or whatever investment funds in Africa have not performed. Mm-hmm. And I think that, and again, there are some exceptions, not many, and most of these and the ones that are actually different are the ones that had staying power, that went through a couple of cycles, defied the original framework that the DFIs came up with, by putting other structures and frameworks in place. But it's so I think, institutional investors, and I don't really blame them, to be honest, because I don't think that it's not yet really a game for institutional investors. So institutional investors, you see them indirectly, mm-hmm. Or you see them in different forms. And again, this is true for part of Africa. So South Africa is a different economy. South Africa is a much more advanced economy. And I think that if you just look at it, so South Africa has a GDP per capita of around $7,000 per $7,000 GDP per capita, which is triple the average of the rest of, or it's more than triple the average of the rest of sub-Saharan Africa. And I think, I don't know exactly, I'm not an economist, but I think that if you get close to the $4,000 mark, you actually reach a tipping point where there is more discretionary income in the country, and people start, and you start truly become a country with more middle income. And so Morocco, you see this, which actually went through that, and you can just see it when you're there. It's becoming a more advanced economy. You see it in South Africa. Of course, there big inequalities in these countries, which make them politically unstable. And also, I think, so that's tricky. But at a minimum, as long as there's some distribution of wealth, you will see an economy that is growing and where people are actually investing in the economy also themselves. And that's the other part of Africa. A lot of people who make money in Africa, the first thing they do is ship it outside of Africa.
Yeah, we know that.
And whether that's money that is made illicit or in a completely legal fashion, people don't like to keep their money in Africa because they don't consider it safe. But it's a vicious circle. Everybody takes money out, nobody reads.
There are other regions that used to suffer from that, but so I mean, in this environment, geopolitical environment and the different markets, how do you put forward your own investment strategy and your own investment vision, and how do you select the countries first and the sectors and the projects that you get involved in?
Yeah, so we are a bit of an odd. There are a few others like us, but we are not a typical investor in the sort of the European or American fashion, in the sense that we basically create our own investment opportunities. So we're a greenfield investor. So what we do is we look at opportunities places where we think that Africa is full of opportunities, but are not necessarily investment grade opportunities. So they're more entrepreneurial opportunities. So what we basically say, okay, well then let's not get in trouble. Let's basically create the business, because there's so much latent demand, there's so much opportunity. Let's try and tap into that. So what we do is we go into opportunities that we create ourselves, and then we expand. Now, for us to be interested, is we need a couple of things. First of all, we think that you need to spread your risks in Africa. So you need only to get into things that you can actually copy in multiple markets. So that, because there is this constant risk between countries, so you need to be able to say, okay, well, this works. And even if one country at some point doesn't really give me the returns or gives me a headache, that's not a good reason to abandon the whole business, because we have other countries where we can do the same thing. So that's one. The other one is that we also think that you need to be able to build something that is large enough. So scalability is a key thing, and that means that certain things we will just not do because it will never become large enough, because even these local markets are too small. The third one is that we recognize that as foreigners, we're just inherently not welcome in Africa. We're just, Africa has, with I think one exception, Ethiopia has been colonized in the past, and that history, while long ago, is still something that is alive and kept alive for political and but also good historical reasons. So we have to realize that we're seen as the neo-colonists, and even if that's completely unjustified for certain things that we do, and even if you could argue that there's another colonization going on that comes from China, for instance, but it's neither here nor there. We're seen that way. So you need to be convinced that you need to be certain that you do something that truly adds value, where local entrepreneurs will not be able to do that. And so that means that we're looking at things that are capital intensive, know-how intensive, and therefore are something that people will not easily do themselves, because it requires a combination of capital and talent or know-how that is not easily replicated or easily initiated locally. And what it gives us a high barrier to entry. High barrier to entry also makes our investment defensible, and makes it also a little less prone to malfeasance, because it is not easy to to take something from somebody if you don't know how to operate it. One of the reasons why a lot of aircraft are not locked on ramps is because the average Joe doesn't know how to fly an aircraft. So why put a lock on the door?
Absolutely.
So that's so I think that's how we look at things. So that means also that if you look at our portfolio, we do we have come up with all sorts of forms of equipment leasing that we call differently.
This is something that I would love to hear more about. Is that what because you chose healthcare among your sectors, and so how does that apply this leasing? How do could you share a case study or of an example of how you actually move forward in one of these cases?
Yeah, so there's a couple of cases. So for instance, I'll get to the healthcare in a second. But to give you an example, we founded Raxio, which is a group of data centers where we still have the majority share in Raxio. We're now joined by another large investor, Meridian, a well-known French infrastructure investor. And Raxio is building data centers, or has built or is building data centers in 7 countries in Africa. But their strategy is to build smaller carrier neutral tier 3 co-location data centers. And it's really on the small end of the spectrum. And why is that? Is because, and in secondary markets, so in markets which are not seen as prime markets. So South Africa as a booming and flourishing data center need and market. But many other countries don't have even a single tier 3 certified tier 3 co-location, carrier neutral co-location data center. Now there is a growing need for these, but these markets are tiny. So what people do who build too much capacity, they get in trouble because they can't fill the capacity. So that's something you see a lot. We build something that is capable of growing to up to 3 megawatt, which is tiny if you compare it to what's happening in the US or in Europe. And then even the 3 megawatt, we built a superstructure for 3 megawatt and the site infrastructure, but we equip it only for the first half megawatt. And that's how we get going now. That's going very well. These data centers are top quality, so we managed to fill them, whereas others who invest in other countries actually have trouble filling the capacity. But we carefully look at, does it make sense? Is the power price good enough? Is there enough demand? Does it make sense for an international customer to come in there? So that's how we do this. So it requires a different approach, and it's an approach that requires patience. So it's not something where you say, I build it, and then immediately after I build it, it's going to be completely full. No, you need to grow with the market, and these markets are much smaller than people think. So that's one example. And it's a great business. It's doing well. It's now a total of $300 million that it has in combination of equity and debt. And I think will continue to grow well, but it also will take time. Now that the other area, so in healthcare, for instance, what we did is we through one of our companies called EASE, that stands for Equipment as a Service. And we actually came up with that because we didn't want to call it lease, because in Africa, leasing is a term that has been hijacked by IFC as a SME funding mechanism that needs to be regulated by the central bank. But what we do is we put MRI and CT scanners on a pay by the drink model in clinics and hospitals. So what we really do is we say, okay, well, you know what? Why don't we? So we invest, let's say, $1.5 million in an MRI scanner. We make sure that it is being installed in the clinic, and then when they use it, they pay us per scan. So what we do is we make sure that it's being maintained. We make sure that the operators are being trained. We take care of the installation, the insurance, the whole jazz. So what we do is basically we take volume risk. So in our due diligence, but in what the company does is when they look at an installation, they really try to figure out, is there enough patient volume? And are they capable of paying either out of pocket or because there is an insurance model? And then we build a payment platform around it that actually collects money. So we try to de-risk it in many ways. And we try to actually get the cash. We try to make the revenue model for that business to get as close to the cash flow of the customer as possible, and with all the variations in it. And it's where the variability is. That means that if it goes to the minimum that you were hoping for, then you don't make any money, and you're just happy to be able to service the loans that you got to buy the equipment. But if it goes better than that, everybody's happy because the price per scan goes down, so the clinic is happy. Our company is happy, Ease is happy because they make a good margin, and the service providers are happy because they actually also make more margin. We spread the load. So that's the kind of models that we look at. So you constantly try to figure out how can I make something fit for the environment that we are actually addressing.
So when you structure these deals in an innovative way, I would say in these different markets, do you also work with outside investors? Do you take on investments? How does that? How do you? And is it all equity, or do you also look at the debt? How do you position it?
No, so well, it depends very much on the situation. So, for instance, anything that looks like equipment leasing, you need debt because otherwise, if you do only equity, you either have not enough return on your equity, or you have to price it way too high. So there we tap into local banks and we try to tap into the DFIs because. And the big missing piece in Africa, and actually not just in Africa, in emerging markets, is for anything that's called equipment leasing, is the securitization, so the refinancing of the debt. That's what we're working on in a separate venture to try and address that, Cathmere. And I think if when that company is live, we expect that to have a major impact on anything that is asset finance or equipment finance, because it really will open up a lot more access to liquidity. So that's on that side. But for instance, we are building a hospital in Addis Ababa, first hospital of a large medical campus. And there we're talking to some large financial institutions, international financial institutions and DFIs to see whether they would be interested, and they are, to provide debt. So but the debt equity ratios in Africa are higher than what you would do in the US or in Europe. That's for sure. Because the risk is high. There's just no question.
So between healthcare, ICT that you mentioned, and the agriculture segment where you're involved, is it depending on each country? There's one of the verticals, or you have the three verticals in every country you invest in?
No, we really take a company by company approach. So we don't, and then so there is no necessary, there is overlap, but not always. So if you look at Ease, for instance, currently is in Nigeria, Ghana, South Africa, and is looking at DRC and Ivory Coast and a few other countries. Tanzania possibly, but if you look at, for instance, Raxio is in Uganda, Ethiopia, Ivory Coast, DRC, Mozambique, Angola, I think, and Tanzania. So there's some overlap, but it follows its own. It follows the market. It follows its own parameters, and then, for instance, if you look at our hospital business, currently only in Addis, we looked at a couple of other projects. We will do another project, but it's very sort of specific for where is there a need, where can we do something. So it's not really, we look at a country and then we decide whether we actually think that for that specific business that country is a good opportunity. To give you an example, we still have a leasing business, equipment leasing business in Ethiopia. We had to shut it down, or we're in the process of shutting it down, because the regulatory framework changed.
Okay.
And that's very unfortunate, because the business was doing great. But that happens. So the regulatory uncertainty in these countries is just part and parcel what you have to live with. Now, that doesn't mean that we no longer invest in Ethiopia, although Ethiopia currently is a very difficult destination. But it means that for this type of business, we definitely will not come back to Ethiopia anytime soon, unless there is a complete change in the financial services sector in Ethiopia. And the National Bank of Ethiopia have created an environment that is just impossible to operate in. And whether it's anything financial services, we will not touch in Ethiopia for quite a while, is my guess.
If you've mentioned, Africa is getting big headlines regardless, whether it's on the geopolitical side, also on pushing positive development and encouraging investment. And this, we've seen it also in Gulf countries, and there's a bigger interest from Gulf countries in investing in Africa. The Gulf region, and Africa. Where or which segments, which sectors do you think that there are opportunities for Gulf investors to get involved in Africa, and should they go hands-on or more on a passive investor positioning beyond the government to government that we all follow and see?
Yeah, so I think Gulf investors, as you know better than I do, have a slightly different risk appetite than, for instance, European or US investors. So Gulf investors, typically Gulf investors like assets and they like yield. Those are the two. I think what makes parts of the African continent easy for them is that, especially for those investors that require Sharia compliance, is that the Muslim population is fairly large in a number of countries, and therefore the economy is also, and the whole structure is set up to do that. So that makes it easy. I think where so the real estate sector in by and large in Africa is a tricky place to play. Markets are distorted by many things for different reasons in different countries. So in some cases you have just there's a huge urbanization going on in Africa. So that in itself is an enormous investment opportunity. But you also land is a really tricky investment target in Africa, because there's a lot of resentment about the people who own land and the reasons how they got it, and whether those are foreigners or locals, it doesn't really matter. So you have to navigate carefully. I think so. That's one side. The other, but I do think that for Gulf investors who are interested in yield in an asset, there are things that they really could do. And so for instance, some of the things that we do are good for are interesting to Gulf investors. Building a hospital, that because hospitals, as in most of the emerging world, because there's no real sufficient patient funding model in most countries. Again, South Africa is different. Part of Northern Africa is different. There's a growing, like India, there's a growing economy around affordable privately owned hospitals that actually can be profitable. So that's something that Gulf investors are interested in typically. Data centers is something that I'm always a little surprised that they're not more interested in it, because that to me is something that Gulf investors should be interested in. But my guess is I don't really understand why that is, but that to me is something that I think they should be interested in. I think once we get the securitization going, so the underlying financial instruments that power asset-backed finance or equipment finance, then that's something that definitely I think they should be interested in as well. because that's an instrument that is yield and relatively safe.
And so if we move on to these different opportunities, and you mentioned, the landscape for private equity firms in Africa, that there's the mitigated the result more on the negative side. Where are these structural problems coming from? Is it the regulatory framework that that's divided between all these 50+ countries? Is it fundraising? Is it deal flow? Or is it just the geopolitical instability that pushes that?
Well, I think to me, I would think about it slightly differently. I think that so I think first and foremost you have to be patient. And that I think a lot of the issues that one of the issues that a lot of these private equity funds, as they are called, has had in Africa is that they were modeled on a sort of a European style private equity model, closed-end fund, 3 or 5 year investment period, and then another 4 or 5 years to farm it out. I don't think that's realistic. You pay school fees in Africa before you actually start making money, and those school fees they're hefty. So if you basically pull out the moment that you pay a few school fees, then you have an issue. And I always said there was a DFI that once told me that they once invested in a poultry business in, I forgot where it was, and I think it was in Egypt, but I'm not entirely certain.
Probably in Egypt, because it was a trend in the 90s.
And then they burnt their fingers on it because they all got sick, and the whole poultry business was. And then they decided not to invest in poultry anymore anywhere in Africa. So they said, well, if you no longer invest in the largest protein source in Africa, then then you have an issue.
Absolutely.
With your mandate that you want to be in literally in the food chain. But that's not the way to go about it. You basically, it failed. Okay, let's learn from it and let's try again. That's the way if you want to be successful. But that requires patience, patient capital as well. The other reason why you need patient capital is because I think the biggest issue is the exit market. There is not really an exit market, and if there is one, it comes in little waves. It's very often hyped, and then all of a sudden the hype dies down again. So I think as an investor, what you need to do is you need to be really an economic value investor. You need to build a company that is profitable, throws off cash, is sustainable, can continue to grow. And then you have just to wait for the right time to exit it. And that could either be a trade sale. It rarely is an IPO because there is almost no capital market that's deep enough to actually carry an IPO in Africa. So you will have to go to a Western market. South Africa has a capital market and a good stock exchange. And again, if you some countries in the north of the Sahara, it's slightly different again. But so that's the other thing. And then so what you get with funding only coming from DFIs who have their own sort of very set in their thinking and have a not purely commercial operational driver, but also blend in all sorts of political views and environmental views, and that changes over time. Then you get and the exit side and the structures on the other end. It also is difficult to get really good teams. So you see generally you don't see the same quality in the private equity teams that you would see in a lot of more industrialized environments. So I think it's not evident. It's not an easy place to do business. Doesn't mean that there aren't great opportunities, but as I said, I think you have to either you have to pick them very carefully, or you have to build them yourselves.
And to conclude our conversation, looking at this environment and beyond the project that you just mentioned, where do you see new projects for AAFC in the future, or new sectors where you would look at more into detail, or is it linked to your securitization project?
No, so I think we see opportunities in renewable energy. We see opportunities in a whole bunch of heavy asset industries. I think where I see the most opportunities is in added value, in adding more added value. So, for instance, I'm not sure whether that's the right example, but if you're interested, for instance, in lithium, there's plenty of lithium in Africa, but where I think you should go is you should actually add the lithium processing to it. And then you start having something that also adds back to the local economy, but gives you also a better and more sustainable base. Now, this is one example, but there are many more. I think that in agriculture, it's one of the biggest opportunities, but it's also one of the most challenging markets. It's because land ownership is difficult. At the same time, Africa has a huge acreage of land that is available for agriculture but not utilized. So if you talk about feeding the world, Africa should be feeding the world.
Absolutely.
It's actually the other way around. Africa is still a net importer of food. But and that's, you asked about Gulf. One of the reasons why Gulf investors are especially interested in the Horn of Africa is food security.
Absolutely.
There's around the Nile, so Sudan, but also in parts of Ethiopia, very fertile land, and potentially a great source of food for the Middle East.
Absolutely. Frans, on a positive note at the end, thank you, because for taking the time and exchanging with us around the African opportunity and what you're doing at AAFC. And we see that at the end you need to be granular in order to succeed, and it might be a lesson for other regions and other sectors as well. Thank you so much for your time, Frans.
You're very welcome. It was a pleasure.